When we think about starting our equity investment journey, one name we often hear is the Nifty 50. And there's a reason for that. It represents 50 of India's leading companies. But here's an interesting point. These 50 companies account for around 43% of the market capitalization of companies listed on the NSE. So what about the remaining 57%? That's a much larger universe of companies beyond the names we already know. And this is important because opportunities in the market don't always come from the same place. Sometimes large cap companies lead the market. At other times, mid caps or small caps may perform better. In fact, if we look at different financial years, we can clearly see that leadership keeps changing. And since predicting the next winning segment isn't easy, broader participation across market caps can be one way to navigate these changing cycles. And that brings us to the Nifty 500 index. The Nifty 500 index gives investors exposure to 500 companies across large cap, mid cap, and small cap segments. Within the index, around 68% comes from stocks represented in the Nifty 100, about 21% from the Nifty Mid Cap 150, and around 11% from the Nifty Small Cap 250. So through one index, you get exposure to established market leaders, rising enterprises, and emerging businesses. The Nifty 500 follows a clearly defined, rules-based approach. Companies first need to meet defined criteria around listing history, liquidity, and trading frequency before the final 500 are selected based on market capitalization. The index is then weighted on free float market cap and reviewed twice a year. So while the coverage is broad, the selection process remains structured and transparent, and the diversification is visible across sectors too. The Nifty 500 gives exposure to 20 sectors. As you can see, capital goods has a 7% weight in the Nifty 500 versus just 1.2% in the Nifty 50, while healthcare is around 7.3% versus 4.8%. It also brings in sectors such as chemicals and realty, which currently have no representation in the Nifty 50. So along with established sectors, the Nifty 500 provides wider participation across different parts of the economy. And when we look at historical data, this broader participation has also reflected in performance. For example, 10 lakh rupees invested in the Nifty 500 TRI on 30th June 1999 would have grown to around 4.28 crore rupees by July 31st, 2026. Similarly, a monthly SIP of 10,000 rupees starting from July 1999 would have grown to around 3.67 crore rupees. And across the period shown here, the Nifty 500 TRI has delivered relatively better annualized and risk-adjusted returns compared with the Nifty 50 TRI and Sensex TRI. Looking at the financial year performance, Nifty 500 TRI has delivered more instances of relatively higher returns compared with Nifty 50 TRI and Sensex TRI. So what does the overall performance story tell us? Historically, the Nifty 500 TRI has shown relatively better potential for long-term wealth creation, more year-on-year wins, and a rolling return edge with over 2.5% average outperformance in the analysis shown. So, to enable investors to participate in this broader market opportunity, we are presenting the UTI Nifty 500 Exchange Traded Fund and the UTI Nifty 500 Index Fund. Both schemes aim to replicate the Nifty 500 index subject to tracking error. Both schemes track the same underlying index. What differs is the way you choose to transact. If you prefer buying and selling units on the stock exchange during market hours and holding them in demat form, you may consider the ETF route. And if you prefer investing directly through a mutual fund at the applicable end-of-day NAV, you may consider the index fund route. So whether you're beginning your equity journey, looking to build a core portfolio, or simply looking for participation beyond large cap companies, the Nifty 500 can offer a broader way to participate in India's equity market. And when investing passively, the experience and processes behind the fund manager also matter. At UTI Mutual Fund, we have been managing passive funds for over 2 decades. Today we manage over 1.90 lakh crore rupees across 31 passive funds, backed by established systems, scale, and over 2 decades of experience in passive investing, with a focus on keeping tracking error and tracking difference low. So investors get not just access to an index, but the experience of an established passive investment platform. The NFO for the UTI Nifty 500 Exchange Traded Fund and UTI Nifty 500 Index Fund is live now, and it closes on 24th August 2026. Because when market leadership keeps changing, sometimes the opportunity is not about choosing one part of the market, it is about participating across the market.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.